time once again for the Wealthy Pilots podcast with Scott Osborn, and we're going to talk about the 7 deadly sins of planning, of finance. And we're going to break this into a 2-part series, so stick around with us as we get into this conversation with Scott. Let's go.
We've got some turbulence up ahead.
Hey everybody, welcome to the podcast. Thanks for hanging out with Scott Osborn and myself as we talk investing, finance, and retirement, my friend, and the 7 deadly sins, I guess, of finance, right? It's however you want to break it up. I think a lot of these could be interwoven with some of the other actual deadly sins, but
the 7 deadly investment sins.
There you go. Yeah, we'll call it that. Okay. Yeah. And so we're going to do this in a 2-part series. We'll just kind of talk a little bit about these and just share some information with folks, and hopefully they'll find that useful and helpful. You doing all right this week?
Oh, fantastic, man.
Yeah, good. You look good.
Loving summer.
Been playing some golf?
Trying to, It's a short season here in Ohio, so you got to enjoy it while you can. But
there you go.
Yeah.
I don't know. It's been awful hot where I'm at, so it's been crazy hot.
Oh yeah, we've set a couple heat records this summer, and I think we're knocking on the door tomorrow. The wave is coming in right now.
It's coming in again, exactly. So enjoy it while you can. All right, let's get into it. So let's talk about number 1. And that is going to be market timing. So we just our last podcast, we talked a little bit about the all-time high, right? So this is definitely a deadly sin when you think about it, because people who get wrapped up in this game, unless you're a day trader, this is really not a good idea.
Yeah, I mean, and again, if we try to define it first, right? Market timing is we're trying to time tops and bottoms of the market, meaning I think it's at a top, so I'm going to sell a portion or all of my portfolio. And then the other portion of market timing will be looking at the bottom side of that. I'm trying to time the bottom of the market for when I'm going to put my money back in. The problem with trying to time the market is if I'm going to do that, then I got to do it multiple times. So I have to get out at the right time, and then I have to get in at the right time. And then I have to repeat that over and over and over and over again.
And I've been married 20 years, and my wife says I'm never right once, let alone twice. So I don't know how that's going to work out for me in that regard.
Yeah, I mean, it is a fool's errand. I'll say that for sure. Yeah. And the data supports it, right? I mean, so in one of the trainings I do, a common thing that we talk about is market timing, because it's probably one of the most common ones I see, and I'll generally see it with my folks that are like 50 and over. When you start to get a larger account balance and you're on the back half of the career where retirement is like starting to, the vision of retirement start to get a little bit more and more clear. That's where I will start to see this behavioral tendency creep in, because I think it's that fear of loss, right? I don't want to lose this money, so I have to start trying to skim the profits and keep them, versus building a plan around that. And yes, we do need to have some money outside of the market, but if you're 55 and you're going to work 10 more years, you really don't, not yet. I mean, we got to build up to that, but you don't need to be, especially taking your whole account balance and moving it in and out, and you're disrupting that compounding with the ownership of the assets, not to mention the loss of dividends when you get over into cash. So, but one of the things that we'll look at is, if you looked at from 1993 to 2023, 30-year period. Okay. Put $100,000 in to the market and let it compound. I'm sorry, you put $10,000 in, let it compound over that time period. It's worth 65 after that time period. If you miss the 10 best days of the market performance in that time frame, your returns are cut in half. And so again,
wow,
it's very, very hard to know. I mean, you just look at people that were timing the market here earlier this year. I mean, you missed the largest day in market history bounce back after the tariff news.
Right.
News is unpredictable, and markets respond to news. Therefore, markets are unpredictable. And so it's a fool's errand to try to time the tops and bottoms, because you don't know what the news cycle is going to bring, and you don't know how the market is going to react to it.
All right. Second sin here, over-diversification. Now, people might go, wait a minute, I thought we're supposed to be diversified.
Yeah, I mean, we don't want all of our eggs in one basket. I would agree with that.
Right.
Now, I do not need 872 baskets for my 872 eggs either.
So you don't need 12 mutual funds, maybe?
Correct. Okay. And this is a very common one where you'll see in a DIY portfolio a whole bunch of funds. You're like, well, look how diversified I am.
Yeah.
But if you
I got them from 5 different companies too. It made it even more.
I got one here. I got one here. I got 2 separate IRAs, one at Fidelity, one at Schwab.
Yeah.
I'm diversified.
Yeah.
No, they both own the same thing. You know what I mean?
Usually a lot of large
Fidelity. Right? Yeah. Schwab or Fidelity is just a custodian. It's not an investment. Right. An IRA or an IRA at this, I mean, it doesn't matter. It's just what do you own in there? If you own a Vanguard large cap growth fund here and you own a Fidelity large cap growth fund here, you own the same thing. You might feel like you own different things, but you own pretty much the same thing.
Yeah, you got 12 mutual funds. You got 12 versions of a lot of tech companies, more than likely, of the same exact ones.
If you just did that Venn diagram to overlap it, it's a lot. It's a lot of this.
For sure.
It's easy to get pulled into because a lot of times, I mean, it's not clear what you're buying, and so it's easy to get pulled into, over diversifying and spreading things out so much. If you got $1,000 in your account, you don't need to own, 1,000 different companies of a share of each company. You don't need to do that. Okay.
Yeah.
As the account grows, we do need more diversification. But you can also be so overly diversified that you're not really even, benefiting from a dollar's perspective, right? If your $10 investment goes up 10%, okay, you're now worth $11 with that holding. We don't need to be so diversified that we actually can't even compound these assets based off how they're performing.
Yeah, you want to have stuff in some different classes so that when things are up, some things are down, and vice versa. But you don't want to get too out there. And so that's the second one. On the third one is the opposite side, right? The under diversification side of things. Obviously, you can just take that same information and go, well, you got to have, to our point, right? So international did well earlier this year when we were stumbling, right? So on and so forth, right? So small cap, medium cap, large cap, all that kind of stuff.
Yeah, I mean, and that's where I think probably the most common thing that I see from an under diversification standpoint is one of two things. Either one, somebody owns a lot of one company stock. It might be their airline for some reason, or it might be a company that they just really like. And when you start to dig into it, it's just really underperformed. Or they've, we'll talk about this in the next sin a little bit, or they're buying a stock that sounded sexy, or they heard it perform really well, so they're buying it.
Oh yeah.
So you can see a lot of holding of one stock. I would call that a version of under diversification.
Well, think about the Enron people. To be cheesy, I mean, it's an easy. I mean, not that situation was cheesy, but to use that as a reference, right? It's a very low hanging fruit, but it makes a lot of sense because people had so much Enron stock that worked there. They felt great about it. And it didn't go so well, right?
Absolutely. Well, and the other thing I'll say is, you mentioned it earlier, but probably the most common one I'd see is like somebody just owning like just one mutual fund or just one index fund.
Right. Right.
And again, I would say owning just the S&P 500 is not necessarily a bad thing if you have a smaller account balance or something like that.
Sure.
If you got $1,000, just buy one fund and let it grow. And then, as it grows, you do want to, have that hedge and that buffer against volatility, because again, if it's important to try to seek to understand the concept of average return versus total return. Yeah. Average return, it is hard to beat the S&P 500, but total return, when we factor in volatility and the ups and the downs, if we can be diversified and rebalance, we can get to the same level of performance many times with a much smoother ride.
Right, without the stress of the roller coaster. Yeah,
absolutely. And and again, this year's a good example where international is grossly outperforming the S&P 500. And you got tons of people out there like, oh, see, this is why we hold it, and that is true. But at the end of the day, it's more about the discipline of, hey, we think these there's good times to own different assets, and each asset will have its own day in the sun. You look back at the Great Recession we had, right? Great financial collapse, 2008, 2009. Mm-hmm. S&P 500 dropped at its low, down 57%. The international or globally diversified investor who owns U.S. stocks, yes, but then also who owned some international, was down 37%. Well, if I go down 37 instead of 57, that's 20% less I got to make on the upside. Right. And so, down 37 is still painful. Don't get me wrong, brother. But,
for sure. Yeah.
But I mean, it's important to, understand that we've had a great run in the S&P 500. Is it going to continue forever? I don't know.
Right.
The history is not on our side with that assumption. So it might be prudent as the account grows to get some diversification in there for sure.
Oh yeah. I mean, could another big downturn happen? Like 08, so on and so forth. Absolutely. Right.
Yes.
So chasing track records is the fourth sin here. And we'll finish up with this one, then we'll finish the last three on our next episode. But chasing track records, a little bit like market timing, maybe, right? But that's why so many, when you get into a portfolio, it says, past performance does not, dictate future results. But I think sometimes people, when it's the, I want $1 million, whether it's the, what's your number kind of thing.
Yeah.
Or I want 12, there's a very famous guy out there with a giant, financial empire that says 12%, 12%, 12%. Yeah. Chasing 12% is maybe not always the most realistic thing.
Well, and again, you can look at that. Like one of the most common things I'll see is somebody either sitting in a target date fund, which I would also say is a mistake, generally underperforming a very basic portfolio. They're sitting in a target date fund. And if they've decided, hey, I need to get out of this target date fund, what we'll typically see is, hey, well, how did you build your portfolio? Well, I went in and I looked at whatever one had the best 1, 3, 5, 10-year track record, and I bought the top two. Well, the downside to that is many times you're buying things after they've had their day in the sun. And so, if you're buying large cap stocks and they've had a big run up, there's a chance they could be coming down through some sort of correction.
I mean, crypto is a great point of that the last couple 100%. Of years. Right. Yeah. Everybody wants to get on the crypto train, but now it's so out of control. You're like, I can't spend that kind of money to get in there.
Well, and again, it kind of goes back to even like some of that discussion where you hear people talk about the S&P 500, it's like, well, if we're just looking at the track record, then why wouldn't we just say, well, let's buy the NASDAQ because that's got a higher average return. And while we're at it, why don't we just get the NASDAQ out and why don't we put 100% of our net worth into NVIDIA stock? Because look at that track record. That's even
right. You're chasing that record. That's that, yeah. And then go back to the prior deadly sin of under-diversification.
Right. Yeah. And so, if I just look at track records, you can pressure test your logic and say, well, why wouldn't you find something that has an even better track record than that?
Yeah.
You know what I mean? And like, if you keep doing that, you start talking yourself into like, yeah, this is actually a lot of risk. You know what I mean? And so, and that's where, again, these sins kind of overlap, but chasing track record is something where I think people get really caught up in the numbers and think, oh, yep, that's what it's done in the past. And then they buy it and they say, hey, this thing's averaged 10%, 12% for 10 years. How come I'm not getting that?
Yeah.
And a lot of times it's because you missed it. And that leads in the frustration that comes after these four sins.
Yeah.
Is what we're going to talk about next time.
Absolutely. Great segue there. So tune in to the next episode. Don't forget to subscribe to us on Apple, Spotify, and of course, YouTube. Hit that subscribe button, thumbs up, and notification bell. And of course, if you need some help, we got links in the description below to get in touch with Scott. You can get yourself onto the calendar and come on in for a consultation and a conversation. And if you'd like to get started with his toolkit, there's a great way to do that. Molly's going to tell you how, and we'll see you next time here on the podcast.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.